Introduction. Hello and welcome back to the second part of our series on smart investment strategies for beginners. In our previous video, we discussed the fundamentals of investing and explored some initial strategies to help beginners get started on their investment journey. If you haven't seen that video yet, make sure to check it out as it provides a solid foundation for what we'll be discussing today. In this video, we will dive deeper into some more advanced investment strategies that can help you maximize your returns while managing risk effectively. Remember, investing is a long-term game, and these strategies require patience, discipline, and a commitment to learning. So, let's jump right in. 1. Diversification. Diversification is a crucial strategy that helps mitigate risk by spreading your investments across different asset classes, industries, and geographic regions. This minimizes the impact of a single poor-performing investment on your overall portfolio. Consider a mix of stocks, bonds, real estate, and even alternative investments like precious metals or cryptocurrencies. Remember, don't put all your eggs in one basket. 2. Dollar cost averaging, DCA. DCA is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This approach reduces the impact of market volatility, as you end up buying more shares when prices are low and fewer shares when prices are high. Over time, this can lead to a lower average cost per share. 3. Value investing. Value investing involves identifying undervalued stocks in the market. Research companies with strong fundamentals that are currently trading below their intrinsic value. While it requires more analysis, this strategy can yield significant gains when the market eventually recognizes the true worth of the companies you've invested in. 4. Growth investing. On the other hand, growth investing focuses on companies with high potential for future growth. These companies might not be highly profitable at the moment, but they are expected to increase their revenue and earnings substantially over time. This strategy can result in higher returns, but it also comes with higher risk. 5. Dividend investing. Dividend investing involves investing in companies that regularly pay dividends to their shareholders. This can provide a steady stream of income and can be particularly appealing for those looking for passive income in addition to potential capital appreciation. 6. Index funds and ETFs. Index funds and exchange-traded funds, ETFs, offer a convenient way to invest in a diversified portfolio that tracks a specific market index. They generally have lower fees compared to actively managed funds and can be a great choice for beginners. 7. Rebalancing. As market conditions change, the allocation of your investments may shift. Rebalancing involves periodically adjusting your portfolio back to your desired asset allocation. This ensures that you don't become overly exposed to one type of investment and helps you maintain your desired risk level. 8. Avoid emotional decision-making. One of the most challenging aspects of investing is controlling your emotions. Emotional decisions, like panic selling during market downturns, can lead to poor outcomes. Stick to your investment plan and focus on the long-term goals you've set. Nine. Continuous learning. The investment landscape is always evolving. Stay updated with financial news, read books, follow reputable investment blogs, and consider taking courses to enhance your investment knowledge. The more you learn, the better equipped you'll be to make informed decisions. 10. Seek professional advice. If you find the investment world overwhelming, don't hesitate to seek advice from financial professionals. A certified financial advisor can provide personalized guidance based on your financial goals and risk tolerance. Conclusion. Investing is a journey that requires education, patience, and discipline. By implementing these smart investment strategies, diversification, dollar cost averaging, value and growth investing, dividend investing, index funds and ETFs, rebalancing, avoiding emotional decisions, continuous learning, and seeking professional advice, you can work towards building a successful investment portfolio. Remember, there's no one-size-fits-all approach. So tailor your strategy to your individual financial goals and risk tolerance. With time and dedication, you can navigate the complexities of investing and put yourself on the path to financial prosperity. Thank you for joining us in this video, and we'll see you in the